Most traders lose money because they chase breakouts that aren't real. But what if I told you there's a simple way to spot the trap before it happens? In this video, I'm going to show you the candle range theory, a strategy that reveals exactly how smart money manipulates the market and how you can trade alongside them instead of against them. In this video, you're going to learn candle range theory basics, the power of three connection, the main CRT patterns, time frame analysis with CRT, real chart examples to show you exactly how to trade in the market, a strategy that works across forex, cryptos, stocks, and commodities, and one you can apply to scalping, day trading, and swing trading. Candle range theory, or CRT, is built on a simple but powerful principle. Every single candlestick on your chart is more than just a shape. It represents a complete range of price action. Think about it this way. When you look at a candle on a higher time frame, that candle reflects the overall movement of the market during that period. But when you zoom into a lower time frame, you'll see the smaller micro movements that actually created that candle. Here's the key. Every candle has a high and a low. These 2 points define its price range, and when you break that range down on smaller time frames, you'll uncover the structure, liquidity, and hidden battles between buyers and sellers happening inside that single candle. That's the foundation of candle range theory, using one candle as a window into the true story of the market. In every market, price doesn't move randomly. It follows a repeating cycle that can be broken down into 3 key phases: accumulation, manipulation, and distribution. Together, these phases are known as the power of 3. And if you want to trade candle range theory successfully, you must understand this structure. So what is the power of 3? It's a smart money concept that explains how institutional traders, the real movers of the market, position themselves before launching a big move. Let's break it down. Consolidation. This is where smart money builds positions. Price moves sideways, trapped inside a tight range. To most retail traders, it looks boring or directionless, but in reality, this is where the groundwork for the next big move is laid. Think of it as the calm before the storm. Manipulation. This is where things get interesting. The market suddenly fakes a breakout, either above resistance or below support, to trap retail traders. This move isn't real. It's designed to grab liquidity and trigger stop losses. We call this a liquidity sweep. The purpose? To shake weak traders out of the market and collect their orders before the real move begins. A liquidity sweep happens when price breaks below a well-defined support level, but instead of continuing lower, it quickly snaps back into the consolidation range. At first glance, it looks like a real breakout. Retail traders rush in, thinking the market is finally moving, while others get stopped out as their protective stop-loss orders are triggered. But in reality, this is a false breakout engineered by smart money. The goal is simple: grab liquidity. Here's the psychology behind it. Retail breakout sellers believe the market is about to crash, so they enter short positions. Traders holding long positions get stopped out, as their stops sit just below support. Smart money uses this pool of liquidity to fill their own positions at the best possible price. Once that liquidity is captured, the market reveals its true intention. Price usually explodes in the opposite direction. This is called the acceleration phase, the powerful move that follows the trap. As smart money traders, our objective is clear. We don't chase the breakout. Instead, we position ourselves to ride the acceleration phase, using the liquidity grab as confirmation that the market has just cleared the path for the real move. The acceleration phase is the explosive move that follows a liquidity sweep. Once smart money has triggered stop losses and collected liquidity, price no longer has obstacles in its way. With retail traders trapped on the wrong side, the market is free to move aggressively in the opposite direction. Here's what happens step by step. Stops are cleared, long traders are forced out, and breakout sellers jump in late. Liquidity is transferred. Smart money takes the other side of those trades, building positions at discount prices. Momentum kicks in. With liquidity secured, institutions drive the market strongly in the intended direction. This surge creates the acceleration phase, the sharp, decisive move where the real profit potential lies. As smart money traders, this is the moment we want to capitalize on. Instead of being trapped by the false breakout, we align with the acceleration, entering trades immediately after the liquidity sweep. By doing so, we ride the momentum created by institutional actions, turning the trap into our opportunity. Now you might be asking, how does candle range theory connect with the power of 3? Here's where it all comes together, and once you see it, you'll never look at a candlestick the same way again. Candle range theory works as your leading indicator on the higher time frame. That single candle, with its high and its low, sets the range where the game will be played. But inside that same candle, on a lower time frame, the power of 3 is unfolding step by step. Think of it like this. The first candle in CRT defines the high and low. This is the accumulation phase on the lower time frame. Price is consolidating, smart money is building positions, and liquidity is stacking at both ends of the range. The second CRT candle often fakes a breakout beyond that range. This is the manipulation phase on the lower time frame. It's the liquidity sweep. Stops are triggered, retail breakout traders get trapped, and smart money collects orders. The third CRT candle is the breakout with conviction. This is the acceleration or distribution phase on the lower time frame. Price